All right, the headline inflation rate for August coming in at 1.9%. It was 1.7 in July. Gas helped to edge the rate higher. Let's get more on this with Michael Davenport, senior economist at Oxford Economics. Thanks for joining us today.
Good afternoon. Thank you for having me.
It wasn't that gas was more expensive. It was that it didn't drop as much as expected. Is August, the period of August, typically a time when gas would drop?
Yes, so exactly as you described, what we saw was really a year-over-year base effect. Typically, we do see gasoline prices edge a little bit lower through the summer months, but ultimately also usually what's driving gasoline prices, and that was the case in the month of August, is movements in global oil prices, so changes in global oil markets. And overall, what we saw was a little bit of an edge higher in oil prices in the month of August, but nothing fairly substantial. And overall, the impact on the inflation rate was, again, really driven by the less favorable comparisons to a year ago, which pushed up the year-over-year contraction in energy prices from close to 10% in the month of July to negative 10% in the month of July to a negative 8% in the month of August. And so that's really was the key factor that pushed up headline inflation.
Okay, leaving out gas, inflation came in at 2.4%. What was the estimate there?
Yeah, so our estimate was actually a little bit higher, as was the consensus. So we had expected core inflation was going to come in closer to 2.6 to 2.7% in August. The consensus expectation was for 2.7%. So like with the headline number, core inflation actually came in a little bit lower than expectations. And overall, what we saw is a relatively positive trend in underlying price pressures. So core inflation, the month-over-month increase, the annualized month-over-month increase in core inflation, which gives a really good measure for the underlying growth in price pressures and where, or the underlying growth in prices and where price pressures are headed going forward, that actually dropped below the Bank of Canada's 2% target for the first time since November of 2024. So we think that's a very positive development from the Bank of Canada's point of view, and will give them a little bit more confidence and comfort that underlying inflationary pressures are contained at this point in time.
Okay, so groceries also came in higher for August. Meat was up more than 7%. Did you see any reason for that?
Well, really, we think that's more of a feature of some monthly volatility in the data. You always see big price movements for different components of food. Meat prices just happen to be the poster child this month. Actually offsetting the increase in meat prices, there was declines in prices for fresh fruits. So grapes, other berries and fresh fruits that kept the overall level of food inflation relatively similar to where it stood in the month of July at 3.4%, up about a tenth from 3.3% the prior month. So although there was some volatility beneath the surface on specific components, meat products in particular, overall, the level of food inflation remained relatively steady.
The removal of the retaliatory tariffs, which happened sort of the end of the summer, September, will this help to steady the inflation outlook? Will it change it that much?
Absolutely. We think it's a big factor that will help to lessen the rise in consumer prices from the trade war. So as you mentioned, nearly all of the Canadian counter tariffs have been removed aside from autos. So nearly all of the non-auto Canadian counter tariffs have been removed as of September 1st. This is going to lessen the increase in costs for Canadian firms. And we think ultimately that will help slow the rise in consumer price inflation. Up until this point in time, we hadn't seen a very big impact in the consumer price data from the pass-through of Canadian counter tariffs to households and to retail and consumer prices. Now, part of that likely reflects the government's fairly comprehensive remission framework that essentially exempted many Canadian products, U.S. products that were being imported into Canada from counter tariffs. So that was one factor. But we did expect that as the counter tariffs remained in place for a longer period, that firms would slowly begin to pass through the costs of those counter tariffs to Canadian households via higher consumer prices. Now that those counter tariffs have largely been removed, that upside risk has diminished considerably. And so that will lessen the increase in consumer price inflation. Overall, we think CPI inflation will continue to rise over the next few months. We expect it's going to settle in the mid 2% range by the middle of next year, but that's quite a bit lower than what we had expected prior to the announcement that the counter tariffs would be removed, when we thought inflation would actually rise closer to 3%.
Okay, so let's talk about the fact that it was 1.9% for August. As you mentioned, the Bank of Canada will announce tomorrow. Can you expand on your logic behind how this fits into the Bank of Canada scenario for a rate cut?
Yeah, absolutely. And I think that is the key takeaway from today's inflation report, that it sort of will solidify the Bank of Canada's view that inflationary pressures are contained enough for now that it can proceed with lower interest rates and deliver a 25 basis point rate cut. So ultimately, we talked a little bit about the counter tariffs. So the removal of counter tariffs really helps to lessen not only the upside risks to inflation from the trade war, but also helps to reduce some of the uncertainty from the trade war as well. And if you look at the Bank of Canada's communication in recent months, it's been quite clear that the key factors that have been keeping it on the sidelines are uncertainty related to the trade war, which has now come down slightly, although it still remains, but also this concern about uncertainty of how counter tariffs in particular would raise costs for Canadian firms and how that would flow through to Canadian consumer prices. So with lower counter tariffs, also, with the economy really struggling, likely to struggle to grow in the second half of this year, we saw a big contraction in GDP in the second quarter, driven by business investment and exports because of the trade war. And we think the economy will continue to teeter on the verge of a recession in the second half of this year. We're also seeing the labor market loosening. And so all of this, we think, adds up to the Bank of Canada being more comfortable that it can cut rates tomorrow and again by 25 basis points in October, albeit somewhat cautiously.
Michael Davenport, appreciate your time joining us on The Close. Michael, senior economist at Oxford Economics.